We've talked about tech lately in the last several months, just kind of as this broad category of reliable growth, and it was all about investor preferences of the moment, a little bit less about maybe the underlying fundamental and technological and earnings trends. Is that pretty much still the conversation? In other words, we have this revival in FANG just as an offset to the cyclical trade cooling off, or are there other things that you think are driving, such as a Facebook up 25% year to date?
I think that's good morning. Thanks for having me. I think that is one of the factors, but I think the other thing that's going on here is more of a return to fundamentals, in that when you look across big cap tech and tech overall, the top line digital trends are not slowing down. The overall trends in the online advertising markets, and the shift from advertising dollars moving offline to online to these big platforms like Facebook, like Alphabet, it continues to accelerate. The consumer expenditure shift from offline shopping to online shopping onto platforms like Amazon and all of the other online platforms also continues to inflect even as the world reopens. And so the top line fundamental drivers are in place. And then secondly, because these companies are so large now, these large bases of revenue are translating into really healthy multi-year profit and free cash flow growth. And so now I think investors have a little more confidence to look into the back half of 21, look into 2022 and say, these companies are not that expensive when you look at the type of free cash flow they have the potential to generate. And so I think it's just it's a return to fundamentals of what's happening from a top line perspective, and how we think about that translating into cash flow next year. And these valuations are still not stretched for big cap tech. When you think about the idea of paying a low double digit free cash flow multiple for high teens to 20% free cash flow growth at a company like Facebook, that's not a quote unquote expensive stock.
Yeah, in fact, as Facebook flirts with a $1 trillion market cap, it looks like it'd be somewhere above 346 on the share price to get to that point. I look at it, relative to other metrics, aside from absolute market value, whether it is, the PE, whether it is the, cash flow multiple and things like that. It's very much in its multi-year range. It's not really kind of gotten out of whack. However, it's also, if you listen to all the Goldman Sachs hedge fund data, the most popular stock in hedge funds right now. I wonder what the incremental edge is to the story here. Is it just, hey, if you want to ignore the regulatory risks, then you can capture further upside?
I think it is going to come down to Facebook. In this case, it's going to come down to their ability to continue to post faster than expected advertising revenue growth over the next, let's call it 2 years, just from both their core products, so core Big Blue news feed, Instagram and Instagram stories, as well as new products that are emerging. There's a lot of still untapped monetization potential at Facebook from things like the product Reels, which is sort of one of their short form video products. They're pushing hard into shopping products to more directly link advertising dollars to transactions on the platform. They're still not monetizing messaging. They're still not monetizing WhatsApp. They're still not getting any credit for virtual reality. So when you sort of step back and say, how can Facebook keep growing as fast as it is, even through laws of large numbers? It's because you have so many still existing untapped monetization optionality on the platform, because they have so much engagement and so many users in their ecosystem.
Shepard Smith here. Thanks for watching CNBC on YouTube.